have immense respect for the task before this committee, rebuilding the American economy from its sharpest downturn in history.
Soon-to-be-confirmed U.S. Treasury Secretary Janet Yellen made the case earlier this past week for many more trillions in stimulus and infrastructure spending ahead.
When economists look back on the pandemic, I expect they'll conclude that Congress's actions averted a lot of suffering. But more must be done. Economists don't always agree, but I think there is a consensus now. Without further action, we risk a longer, more painful recession now and longer-term scarring of the economy later. Neither the president-elect nor I proposed this relief package without an appreciation for the country's debt burden. But right now, with interest rates at historic lows, the smartest thing we can do is act big. In the long run, I believe the benefits will far outweigh the costs. As Treasury Secretary, I think there will be a dual mission too, helping Americans endure the final months of this pandemic, keeping people safe while getting them back to work. That's our first task. But then there's the longer-term project. We have to rebuild our economy so that it creates more prosperity for more people and ensures that American workers can compete in an increasingly competitive global economy.
All of this, of course, will be financed out of thin air and rationalized given the viral shock to the economy and still currently historically low interest rates at the moment. Of course, ours is not the only privately owned central bank in the world, currently creating currency out of thin air and adding assets to their balance sheet. This year, 2021, we can again expect the private Federal Reserve's balance sheet to balloon as the U.S. government rolls over and refinances a record $8.5 trillion in government IOUs. Simultaneously this week, as Janet Yellen was telling us to spend many more trillions we have not saved, a record-sized one-day inflow of over $500 million showed up in silver derivative markets. Apparently, silver bulls are again laying down long bets, assuming silver spot prices are going to ramp and rise, given all the upcoming trillions in stimulus behind and ahead. This week, we had the largest one-day silver derivative capital inflow in over 8 years of time, mainly into the largest ETF called SLV. $500 million in silver is currently over 20 million troy ounces, or 600 metric tons. For context, we humans produce about 2.2 million ounces of new silver ore per day, so roughly 9 times the amount that we typically produce was inflowed in that one day of trading. Hello there, on behalf of SDBullion.com, this is James Anderson, and this is your week's SD Bullion Market Update. Before we continue, please take a moment and smash the like button. Be sure to subscribe and also share this content with those you believe may also find it valuable. The monetary metals moved sideways and slightly up this past week's trading. Gold-silver ratio is still hovering in the low 70s at the moment. The silver price in Mexican pesos is like the silver price in Indian rupee terms, beginning this year only a few good trading days away from an all-time record high price. And given that Mexico remains the world's largest silver producer, their soon new record silver price foreshadows where we are all headed sooner than later, denominated in every fiat currency around the world. General commodity values currently appear to be turning up after a 12-year downturn. It's no surprise to see precious metals like platinum showing buoyancy, currently priced above $1,000 per troy ounce to begin the year. If we are indeed turning the corner for a coming commodity bull market, this now 100-year historic premium of gold over platinum will likely tighten back towards historic norms later on this decade. Turning to the ongoing mania in the U.S. stock markets, insider stock selling versus buying by corporate executives has recently hit an all-time high level. This chart's data goes back 30 years of time, and it shows that corporate executives are selling stocks at a massively large ratio versus how much they are buying. Today we witnessed GameStop's stock price hit an all-time high based on a short squeeze, mainly pushed by call option buying bets from a subreddit called Wall Street Bets. Based on next to no real company fundamentals, but more so on a short squeeze on call option market makers and shorts, this stock's price, within a handful of months, went from its all-time low to an all-time high price, reached today in the speculative U.S. stock market. At the start of this year, 2021, Berkshire Hathaway billionaire Charlie Munger, a man who made his funds and money through decades of stock investing, he had a gloomy take on where the U.S. stock market is headed this decade in real value terms. Have a listen.
To have lower returns in the equity markets than the last 10? He doesn't give us an idea why?
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
Two different questions. What do you think of the combinations of quantitative easing and large fiscal deficit? And where are they going to lead us?
Well, there I've got a very simple answer, and that is, it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
It is remarkable how much we've expanded the money supply, how low interest rates are, and how little initial response there's been on.
Remarkable is not too strong a word. Astounding would be more like it.
I will let you choose the adjective, Charlie.
It's unbelievably extreme. Some European government borrowed money recently for some tiny little fraction of 1% for 100 years. Now that is weird.
So
What kind of a lunatic would loan money to a European government for 100 years at less than 1%?
Is the NASDAQ in a bubble?
Well, nobody knows when bubbles are going to blow up. But just because it's NASDAQ doesn't mean it'll have another run like this one very quickly again. This has been unbelievable. Again, there's never been anything quite like it. If you stop to think about it, think what Apple is worth compared to John D. Rockefeller's old oil empire. It's been the most dramatic thing that's almost ever happened in the entire world history of finance.
So as we look out to the further building wall of debt and seemingly infinite stimulus about to be foisted into our financial system in the years unfolding, we thinkers about the future are left to ponder, how in the hell are we going to get out from the hundreds of trillions in unfunded debt and promise piles collectively coming due this decade and into the next? What happens once the interest on this growing debt overwhelms the diverging revenue growth and our collective faith in this system? Well, an over 5-decade Wall Street market veteran, Victor Sperandeo, last year expressed his take on the endgame or transition phase for the U.S. ahead. And on his website, he writes that he's 100% certain this will not end in bankruptcy. Of course, that makes sense. After all, the Federal Reserve and U.S. Treasury meld, they have an infinite fiat currency creating keyboard at their disposal. Rather, his belief is that this system's end and transition will be through an eventual hyperinflation, where we nominally devalue these seemingly ever-growing promise piles in a handful of painful months. The following audio is courtesy of the Market Huddle podcast from late June of last year, 2020.
If you have 30 trillion in debt, as we have roughly at the end of this year, I'm talking December, and you're never going to pay it back, but you can inflate it away, you can do it in 4 months. 4 months at 50% at hyperinflation rates, and then it would be over. You'd have about 10% of the debt left, about 3 trillion, and the rest would be inflated away. So you only need to do this for 4 months. So in my view, that's the end game. It's going to be hyperinflation for a very short period of time. Everybody's going to go crazy, go through the roof. Venezuela's done this now. I mean, they're still walking and talking over there. I mean, Maduro's still, president. I mean, it only takes 4 months. And what happens is 90% of whatever you have in cash is gone in 4 months.
Of course, Victor's endgame thesis is likely years out into the future, and hopefully does not come to pass. But it's a real possibility in that record in debt governments often choose inflation over bankruptcy as the easier way out when cornered by their collective actions and comeuppance. That is it for this week's update. Take great care of yourselves and those you love.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.